A very special episode today. We have two great guests, Peter Grandich and Michael Gentile. Peter has been on the new show several times. He is a founder of Peter Grandich Co. Michael Gentile is a co-founder of Bastion Asset Management. Good to reconnect with you, Michael. It's been a while. The audience loves you. So the audience loves you both. Welcome, both gentlemen. Honored to host you both at the same time. Thank you for being here.
Thank you, David.
David, good to see you again.
We're going to be talking about what is going on with the economy and how the issues that we face today could affect our investments. Michael, I'd like to start with you. We spoke a long time ago, about a year ago, about how interest rates hitting higher levels could be a huge problem for the United States. I remember you telling me that should we get to 5%, the Treasury is going to have difficulties paying back interest expenses. Now, I believe as of the latest data in the St. Louis Fed, interest expenses are nearing or just surpassed $1 trillion. However, tax receipts are still just shy of $3 trillion. So there's still some leeway left. It's not like tax receipts can't cover interest expenses. So do we have a problem or not is my question.
Yeah, it's funny. Going back a couple of years, I think the first time we spoke, interest rates were zero. I remember telling your audience on your previous show that if rates ever went to 5%, we'd have some serious issues fiscally in the United States. Well, that theory is now a practical reality. A couple of weeks ago, as you know, David, the 10-year touched 10%. Just to update your audience on the debt numbers, the current deficit in the United States is approximately $34 trillion at a 5% interest rate. Just simple math, when that debt rolls over the next 2, 3, 4 years and rates reset on the overall debt in the United States, you've got $1.7 trillion of interest expense. Last year, David, in the United States, 2022, they took in $5 trillion of tax revenue federally. So that 1.7 is now over 30% of overall tax revenue, which is an astronomically high percentage once the rates reset higher. It's not that yet, but it's on its way. I think it crossed $1 trillion of real live expenses today, but it's on its way to 1.7 trillion. The biggest expense in the United States, David, is Social Security at 22% of revenues. Healthcare and defense are 10 to 15% of revenues. So the interest on the debt will be 3 times what they spend on defense spending and 150% of what they spend on Social Security. Those are simply terrifying numbers, David, and completely unsustainable. And you're starting to see that in the bond market. We had another kind of semi-failed bond auction today. This went off about 15 minutes ago before we started talking. The bond market's starting to revolt a little bit at the seams, saying we don't want to buy this debt at 4.5% because they're not convinced that the U.S. government's going to be paying them back in dollars that are worth anywhere close to what they're worth today. So very, very concerning, David. The foreign countries see that too. The big buyers of debt, the Russians, the Chinese, the Indians have been selling treasuries, no longer buying treasuries. There's a bit of a buyer strike going on in the bond market right now, and that means higher rates are required to convince buyers to come in and soak up that excessive deficit, excessive supply that they're seeing right now.
Peter, I would like to get your take, but just to follow up on what you said, Michael, so it's unsustainable. Those were your words. What is the next step? What is the solution to solving this unsustainability? Are we going to see higher taxes? Are we going to see austerity? What is the government going to do about this?
There's a few paths forward, David. One would involve real rationing or austerity. I don't call it austerity. When you're running $2 to $3 trillion deficits, I'd call it just common sense balancing the budget. Unfortunately, how left we swung in our society, running a balanced budget is considered austerity these days. But really what you have to do is balance the budget and start getting more productivity growth in your economy. So grow your economy faster than your expenses. I don't see the political will. Peter's based in the US, I'm based in Canada. I don't see the political will anywhere in Canada and the US for any type of cutbacks, any type of austerity, any type of pro-prosperity, pro-productivity measures. So that measure for now, David, does not seem like it's one you want to produce. So the only option we really have is monetization of the debt. So some kind of yield curve control like we've seen in Japan, or running inflation hotter than we have in the past, 3, 4, 5%, and capping rates. So basically what I'm saying, David, is negative real rates would allow you to float this higher debt without sinking the economy. And I think that's what the bond market is starting to sniff out, that the dollars that are going to be paid back in are going to be much worse, much less. Inflation is going to have to be run hotter, and the governments are not responsible enough to rein in spending. The debt is also so high, David, right now, that I think you're almost past the point of austerity. $34 trillion of debt. I don't know how much productivity or tax dollars you can squeeze out of the economy to rein that in. I think monetization or devaluation of the dollar is really the only way you're going to pay off this debt in the long term.
Peter, could you please add to what Michael's saying? So you gave me a chart. I'm going to show it on the screen here. Big debts. This is from the Bank of America, and as of 2023, you've got like Michael said, $34 trillion of debt. The CPO is projecting about $50 trillion in the next 10 years. When you see this chart, what is your initial reaction, Peter?
Well, my reaction was to take the time to record a video today to my clients, friends, and followers saying that for all practical purposes, we sadly have reached DEFCON 5. We now see the Congressional Budget Office, the last bastion of semi-bipartisanship that exists still in Washington, D.C., stating that not only do they see it going up 20 trillion in the next 10 years, but because of how out of control deficit spending is now, it could be as soon as 6 years from now. And the difference in that, David, is after spending 40 years in and around the financial arena, this is not something new that people started to fear and think about. But when we talked about it 10 or 20 years ago, it was almost another lifetime away. Now it's within the realm of most people who will watch this show's lifespan. And that is, to me, an unbelievable circumstances at a time when two parties who would be called upon to try to make or take some of the actions Michael spoke about, who not only can't get in the room with each other, but they can't even get in the room with some of their own people in their own party. So the political will is non-existent. The financial will is greatly lost. And quite frankly, I don't see an easy way out. And that's the biggest concern. And I put with an asterisk, as I did today, I don't sell anything or profit from anything because of that fear or having that happen. In fact, my planning business suffers because of taking this position. But it is a reality now. It's no longer something off in the distance. It's right in front of us. And most people, and certainly most people on Wall Street, continue to ignore it, treat it as skeptical, or say to themselves, I'll worry about it tomorrow. Well, tomorrow's here now.
Peter, you've talked to me about.
Correct me if I'm wrong, Peter, but the CBO numbers that you talked about, they're not even modeling in a recession in that 6-year horizon. So, if you're running $2 to $3 trillion deficits today when the economy is doing relatively well, imagine what happens in a recessionary environment. We saw what happened in the global financial crisis. Your revenues get cut dramatically, but your expenditures actually go up. So another scary thing about these forecasts, David, and both Canada's the same. Nobody ever models a recession, even though we have recessions every 5-10 years cyclically in our economy. They forget to model them in the projections. So I think the projections that Peter showed in the chart today are actually too low. I think that could be significantly higher, and a recession is inevitable, in my opinion, and that's going to only make the situation worse.
Have you ever wondered what the assumptions are behind these projections? I mean, fundamentally, why does the nominal value of the debt need to skyrocket to, well, with 34 to 50 trillion? That's almost an 80% increase over the next 10 years. Why can't we just pay back the debt we have now? Why do we need to add more debt? What are the assumptions behind this forecast?
So,
I'll let anyone take it. Peter, go ahead.
So let's start with here in the US, and I don't know the number in Canada, Michael probably does, but 65% of Americans are working paycheck to paycheck. That's literally just being able to pay simple bills in order to survive. Where do they earn enough to pay extra to pay down the debt that their families and grandparents and all led to? And to such a level is impossible. Second, what do you do when you spend more than you take in? Well, we continue to do it. The latest numbers that came out of Washington showed consumer spending at 0.7% and personal income up 0.3%. Now, David, you went to school a few years after I did, but I don't think it's changed. If you have something that costs $7, but you only have $3 in your pocket, you have to borrow the other $4. And that's the mentality still that exists. 7 to 8 out of 10 families that we still sit with in our planning group, from day-to-day workers to athletes that used to make tens of millions of dollars they dealt with, are all living 1 to 2 financial levels above where they really should be. And that has been by foregoing things that you're going to need in the future, retirement and what have you, health costs and all, and also borrowing. And it's also another important factor that doesn't get into these discussions. It's a lifestyle that people have chosen to live, and they're dependent on that. The returns that had existed in the market because of all that money that was created and gave financial markets an artificial lift that really is not going to be available to them anymore. So when you asked about, and you said to Michael, what do we do to solve this? I don't think people are in a position to, or even if they understood it, are willing to. It's going to take a crisis unyet seen in America's history to finally bring some sanity back to this. And I think it takes a generation or more, David. I'll be long gone. Hopefully you'll still be around and ticking, but I think it could take that long before you could ever think about returning to what, when I started in the business 40 years ago, America was the largest creditor nation. We had less than $1 trillion in debt. Now we have 33 on the way to 50 plus.
The longer term trend of growing debt really started in the 80s. I'm looking at the gross federal debt as a percentage of GDP chart from the St. Louis Fed. We are currently at the same level as we were in the United States in 1945. So the last time the debt to GDP ratio was this high in the US was right at the end of World War II. And we know why, because the US racked up a bunch of debt during the war. Michael, just to follow up on what Peter said, why is it that debt has accumulated so rapidly over the last 40 years in the US relative to GDP?
Lost a sense of sacrifice. Peter mentioned earlier, we've been living above our means. When I say we, I mean each individual person and the governments as a whole. The governments are a function of the population, right? So the population has gotten, I don't want to say soft, but probably gone soft. They've gotten accustomed to debt-fueled lifestyle increases. So as Peter said, if you're printing money and you're strapping on debt, you can live well above your means for decades until the rooster crows, right? In terms of until the hen comes calling you. And so that's really the problem we have, David, is we've been living well above our means, fueled by debt. And now the check's coming to be paid and we don't have the ability to pay it back. So I think what has to happen is people have to work harder, spend less, get used to having less, get used to living a less luxurious lifestyle than they're accustomed to. That's how you get out of the problem. But David, I don't see that sense of sacrifice or desire to do that anywhere. And the only time that happened, it happened in Canada in the 90s. David, you might remember that, when Canada almost hit a wall financially. Then we rolled in massive spending cuts. It was a very difficult 5 to 10 year period, and the Liberals and the Conservatives balanced the budget out, reduced the debt, got our yields under control. And that led to a period of a good 10, 20 years of prosperity in Canada. And we've completely forgot those lessons again. During COVID, we doubled our debt in Canada. Same mistakes. There was no war. There was no reason to do it, and yet we did. And so now we're going to have to roll up our sleeves and pay it back the hard way, which either with inflation or with shared sacrifice. And I think the market's going to choose inflation because sacrifice is too difficult.
And David, I think the thing you have to also take into account, we had the luxury of a world reserve currency that happened to be ours and gave us affordability to get more into debt. That's changing. First of all, we know statistically there's less ownership of dollars now than there was 10, 20, or 30 years ago. But I think it's a mistake, and I believe Wall Street, in one of its many mistakes, continues to underestimate the impact of what this BRIC nation movement is going to do to the world and how it's going to be impacted. And the watershed effect was Saudi Arabia's decision to basically say, we're no longer America's best and only pal, and we're just going to deal in dollars. We're now looking to be involved in other areas, including this BRIC nation, and we're looking and willing to sell our oil other than in dollars. And if and when there's an alternative or an additional or whatever competition you want to call it, and these dollars that currently are just used by people are no longer used, they have to go somewhere, David. They just don't go up in the air. And that's another major inflationary cycle that's going to be before us. And again, we're doing this all at a time when we don't have any political will. And as America, we're losing, if you want to call it dominance or influence, whatever you want to call it, throughout the world, economically, socially, and politically.
What about the economic growth side? So we've talked about debt. Now, the other side of the equation, the GDP side. If you were to take the side of the CBO, which is to say that debt will grow from 34 to 50 trillion over the next 10 years, that's roughly about 80% increase. Do you think nominal GDP will also grow at the same pace? Because if not, we're going to see the debt to GDP ratio really expand, right?
Question. I'd say, David, on that front, that's why I'm convinced that the federal banks and the governments are going to tolerate higher than historical inflation for the next several decades. Because if you have inflation that's running 3, 4, 5% a year, your economy might grow 0% GDP wise, but in inflation adjusted terms, it's up 3, 4, 5%. So your debt is fixed. If your economy is growing just by the fact that prices are up 5% every year, you're getting 5% GDP growth from that. That allows you to pay down your debt faster because your debt's fixed. Now, you made a very good point, David. The key is to make sure your debt doesn't grow as fast as inflation. And the problem we have right now is that our governments are completely out of control with their spending. the interest expense is such a large proponent of the budget now, it's very hard for them to cut the deficit or the growth of the debt below inflation. So inflation has to run hotter. We've got to find a way to get our expenses down so that we can pay back that debt in less valuable dollars over time.
Michael, can we get high real GDP growth, which is to say lower inflation than nominal growth? So high nominal GDP growth, but relatively low inflation. Is that possible?
It's going to be tough because high rates choke off economic growth. The government, having as much deficit as they are choking off economic growth. The most efficient allocators of capital, David, are definitely not the government. Just look at any government program that gets involved in the private sector. They'd all get fired as investment managers. They're investment managers like me because the returns on investment are terrible. But when the government's borrowing that much money, forcing rates higher, that puts a tax on other investments. So investments that would have been made when rates were 2% are not going to be made when rates are 6, 7, or 8, 9% borrowing costs for corporates. So that chokes off economic growth as well. So there's this negative cycle that starts to happen when you have high inflation, higher rates. It hurts the economy, hurts productivity. So you've got to get that under control. And like Peter said, the only way that usually start to see government discipline is when you hit a real financial wall. When the bond market, you don't have bad bond market auctions, you have a failed bond market auction when the bonds are just not bought at all. That's when you'll see the governments maybe come to their senses. But by that time, as Peter says, it may be too late for them to put the genie back in the bottle.
Okay, so let's talk. Yeah, please go ahead.
I'm sorry, David. I think there's two other things we have to look at. Michael said it early in the discussion, which is very important, even about today's bond financing. When we had this unfortunate, terrible Middle East situation break out on ourselves, years ago, you would have saw a tremendous rally in the bond market, particularly in the treasury bills and bonds. We didn't see that this time. And there's a reason for that, for what Michael stated earlier. But there's another reason. And when I talk to people outside the United States that still would consider investing in the US. One person who runs quite a bit of money out of Europe said to me, would you keep lending money to your kids if every time you gave them a level of spending and they keep going over it? I say, no, I would have great difficulty with my child. Well, that's what we're doing. We're about to do it again. I don't know what number this is, 70 or 72, but we're about to raise the debt ceiling limit again, if they actually get around to it, instead of just pushing it forward like they did earlier this year. And that is really getting to the point where the people who we would hope will be out there as they've been in the past, irregardless of BRIC or whatever, are getting to the point where they literally see the United States completely out of control of its own finances and are going to demand a much higher rate to lend money to us, irregardless of what our economy is doing.
How have higher rates changed your portfolio asset allocation or investment priorities? Peter, I'll start with you. Like Michael pointed out earlier in the interview, 10 years gone up to 16-year highs earlier in October. It's come down somewhat, but the yield is still high by historical standards. Has that made you allocate more to cash, or does that not change your outlook at all?
Well, I made a tremendous move personally 2 years ago because of what I think is people don't realize what's happening to the levels socially, politically, and economically. So my exposure is just in T-bills. I do not want to have paper, certainly, as Michael said, unless there's a much higher interest rate coming down the road. And I'm quite happy to take 4 or 5% for the next 6, 12 months, up to 2 years. I'll tell you what I do think, and I don't want to swing the conversation, but we should talk about before it ends. About a year or so ago, gold was around 1650. And the bears at that time said, well, rates are going to go higher here now. And that's going to be very bearish for gold. That's why we think 1400 or 1100's in the cards. And here we are 12 to 16 months later, and gold's knocking on the door of 2000 again. And rates went from 0 to 1% to 4 to 5%. So one thing I think people should get out of their mind, if they're interested in gold as I am, is that somehow higher interest rates are always bad for gold. That has been proven not to be the case in the last 12 months. And I think one of the reasons gold has benefited is because now some of that money that would have ran to treasuries because of safety literally ran to physical gold.
I do want to come back to gold in more detail in just a bit, but same question to you, Michael, first. How have higher yields changed your investment thesis?
So I'd say at Bastion Asset Management, we were investing in small mid-cap companies in Canada and the US between 100 million to say 10 billion market cap. We've seen huge changes in the market dynamics, David. You've seen the Russell, which is a small cap index, go down about 20-25% over the last 2 years. The larger companies are still hanging in there, the Magnificent Seven, the S&P. What's really happening, David, is when rates were 0%, if your company was losing money, was able to finance itself. What's happening now is the companies that have negative free cash flow or maybe over-levered balance sheets are getting demolished in the market. They're getting absolutely crushed because the cost of capital, the ability for these companies to refinance themselves is dramatically lower. And this is a problem for the economy, David, because these companies tend to be the faster growing companies, the more innovative companies, tech companies. The financing ability to finance yourself is dramatically been reduced due to higher rates, which is going to cause a big drag on the economy. So balance sheets matter much more than they did 2 years ago. Free cash flow, self-sustained. Warren Buffett used to say, David, he likes to invest in companies when if the stock market's closed for 2 years, he can sleep well. And basically what he means by that is the companies generate enough free cash flow to fund their own business. They don't need to issue equity or issue bonds in the market to fund themselves. So that's been a major, major change in the market dynamics over the last 12 months.
Michael, I want to ask you this. I've heard this from another economist. Are you seeing companies gaining more interest income because perhaps they're holding more treasuries or T-bills, and because of higher rates, they're gaining? Like, is that happening?
Yeah, I mean, if you look at the big tech companies, they have billions of dollars of cash on their balance sheet. The interest income on that cash is actually becoming a material contributor to their earnings numbers. So yeah, there is companies that are benefiting from having cash on the balance sheet for the first time. I don't know how much a multiple you're going to pay on a PE multiple for interest income on someone's balance sheet, but definitely helpful for the companies that have cash. So balance sheets, free cash flow, ability to self-finance yourselves, that's changed the market dynamic significantly in the last 12 months.
Peter, just to follow up on what Michael said about interest expenses weighing down on capital raising, are you seeing that in the junior mining space because of higher rates? Are you seeing a slowdown in capital flows?
Well, in the junior market, there's only one capital flow out.
Okay.
I certainly can attest that in my own portfolio, but in the major mining, which is really interesting, and Michael is far more of an expert in this area, can address it. But I think what that has done is, for the first time that I can recall back to my money management days, some of these major mining producers have such great free cash flow now and assets out there. Why? And I know I'm getting off the subject, but I think it's important so we don't lose sight of this. I go out and start to develop your own potential mine from start grassroots if you're a major miner, when there's so many companies out there that have resources that are being valued anywhere from $5 to $15 an ounce, which I think is a subject to talk about, is the coming merger mania, first out of necessity and then out of for growth potential that's going to occur in 2024 now, because of the pricing that many of the smaller mining companies and it's clearly the exploration companies have been driven down to. Mike sits on boards, and I'm sure he can share about that to you too.
Yeah, please, Michael, could you respond to that?
Yeah, I'd say the junior resource market, or any company that's consuming capital. Junior resource market is the most extreme example of that right now. The financing ability in that market is as bad as I've seen in 25 years. Despite gold being at $2,000 an ounce, there is zero money available for junior exploration right now in the sector. I mean, it is very, very dire, which is pretty unique, Dave, when you juxtapose that against the fact that, as Peter said, gold is a couple of percent off all-time high prices. You would think that gold's trading at $1,100, $1,200 an ounce, looking at the junior mining stocks today. And so when you match that up with the fact that the senior companies are now debt-free balance sheets, generating a lot of free cash flow, the industry overall is very, very healthy, but the funding available for the earlier stage and more speculative investments in the sector is extremely weak. Now, your investor might say, oh, that's really bad. But it's actually the best time to invest when there is no capital available in any industry, because when there's no capital available, that means those that are investing are going to earn incredibly high returns, right? The more capital is chasing an industry, the lower the returns are going to be. If everybody wants to buy bonds, yields are going to go down. If nobody wants to buy bonds, yields are going to go up. Same thing in junior resource stocks. If nobody wants to buy them, the returns for those that do buy them here are going to be very, very high going forward.
I understand the valuation aspect, or the thesis here. Maybe the junior miners are undervalued compared to the raw commodities, but if, like what you said, is true, then wouldn't we also see a slowdown in drilling activity? Wouldn't we see a slowdown in potential M&A interest from the seniors? My question is, why will we get in now when everything just slowing down?
So you're definitely seeing a slowdown in drilling activity. The drill budgets for most junior exploration companies are down 95% from where they were 2 years ago. So drilling is definitely slowed down dramatically. On the M&A front, you can go and buy resource companies, junior resource companies today at $5 to $10 an ounce in the ground, when the cost to discover a deposit full cycle may be anywhere from $50 to $200 an ounce. So why would you go, if you're a senior major mining company, why would you go and do grassroots exploration drilling when you can pick up quality projects with resources already discovered? All the risk is out of it at $5, $10 an ounce. So that's what Peter was alluding to earlier. I expect to see a big wave of M&A as the seniors with the strong balance sheets and the strong currency of stock prices say, I can build it or I can buy it. Well, if building it costs me 10 times more than buying it, I'm probably going to keep buying it. And that's what you're going to start to see happen. That'll be the real kickoff of the rally in the sector you're going to start to see in the next several years.
Either one of you could take my next question. Oh, sorry, Peter, go ahead. Yeah.
There's an old saying, David, that's been around for years. Never say this time it's different. But actually, you can say that now regarding minors and juniors, because in the past, you'd be right, things slow down, there'd be less interest, there'd be ample supply of metals. The problem is if you buy the argument of where the world is going and the need for metals for that, never has it been the discrepancy. There isn't excess supply in nickel or copper or some of the other metals and some of the newer things now that we need because of where the world has gone to phosphate and lithium and things of that nature. So while that has slowed, and the people who would normally be finding that stuff in abundance have basically spent the last 10 years ratcheting down, and ratcheting down, while supposedly the future demand of this, where the world is still going, if you're going to be bullish about stocks and believe all these forecasts, the discrepancy between potential supply versus potential demand has never been greater in my view book. And that's why I think despite and having to live through across the board 50-80% losses in juniors, anybody with reasonable projects, I know Michael has a couple companies where they're valuing the known resource somewhere between $8 and $10 an ounce. That is just an historically knock on the door best opportunity there is. And of course, when everybody wants to kill you for saying that, especially in your own household, then you really know that we really are at an extreme. And like I said, I really think there's going to be an unbelievable, compared to past years, mergers and acquisitions in the mining, particularly because of what's happening in the world. Look what just happened. This is really important, David. Look what just happened in Panama. Here's a company, I don't know how much they actually spent to build this mine, but hundreds of millions, if not $1 billion or more. And basically the country turned around and said, either do it our way or the highway. And I think that's also going to shrink the world that used to exist, where you could go and feel safe and do a lot of things. So all the things point to, as bad as that market is right now, the metals and mining, particularly on the junior end, I think there's going to be an unbelievable reversal, and it's going to be parabolic.
Juniors investors are interested in, several different exit ops, but takeouts being one of them. The M&A in the space, is it counter-cyclical or cyclical to the equity sectors overall? In other words, if the stock markets, the S&P, the NASDAQ go up, are we seeing more or less M&A? Presumably when valuations are low, that's when you want to be buying things, right? But is that really how it works? I'll let whoever wants to take that question go.
Unfortunately, David, maybe it'll be different this time, but historically, the commodity sector sees peak M&A at the peak of the cycle. And that's why a lot of these companies have destroyed a lot of value. The last mega M&A cycle we saw in gold was between 2010 and 2012, and that was right before gold rolled over. What you should be doing, if the major mining producers are listening, is you should be buying now when there's blood on the streets, when valuations are at 20, 30-year lows. That's how you create a lot of value. Most seniors and corporates and boards want to wait for the validation of their peers. So typically what happens, you'll see one deal, and you'll see two, and you'll see 3, and then you'll see 20, because all the other boards say, okay, now the cycle's on, I got to get involved, and every single deal is done at a higher valuation. So you're right there. At the lows, you typically see very little financing and very little M&A. Once the M&A cycle starts to go, it'll really dramatically accelerate over a kind of 2 to 3 year period. But the time to buy is now. So for the nice thing about public markets is your viewers can buy these stocks now, and the corporates will be coming in buying them 2-3 years later at maybe 200-300% higher than they are today.
What happened in 2020?
Sorry, Dave. I'm sorry for interrupting you again.
That's okay.
I wanted to say that a perfect example of that is what happened with uranium. If you go back 5 years, 2018, 19, 20, and you talked about uranium after just so many years of people hearing about it, because it had one tremendous run several years before that, people just said there's just no way, and they priced it. Uranium went under 20. Companies like Cameco were selling in single digits, and yet there was a perceived swing coming. There was a recognition already about future energy needs, but it took 2 to 3 years and seeing that again and again before finally, as Michael said, the crowd went with it. Yeah, a handful of people said something here and here. Now we're only getting to the acceleration where money managers are going, wait a minute, my competitors are out there talking about it. I hate to say this, and this is not a disrespect to Michael, but like anything else, they have a herd mentality. And right now, there is no herd on the buy side of mining shares, particularly in the junior. There's a dribble of a few people left. And I just think when that swings, and it swings, it'll swing exponentially farther because the supply and demand story is so much better now than in previous cycles.
So the key takeaway that I'm getting from today's conversation that I'm learning right now is that the M&A activity or appetite, if you want to call it that, is more related to appetite with speculation in smaller stocks and more speculative investments overall in the equity space, not so much with gold. Is that correct? Because gold is already near all-time highs again this year.
The lack of interest in speculation is being affected by higher interest rates and just negative sentiment, David.
I see.
Okay. I've never seen this in my 25-year career though. What Peter's saying is typically when you see stocks trading like this, it's like uranium was in 2018. It was 20 bucks a pound, and there was so much negativity. You know, Japan's never going to restart the nuclear reactors. It was a terrible disaster. I've never seen this juxtaposition of incredible fundamentals on the commodity side and terrible fundamental stock prices. That is a very rare and unique setup that I've seldom seen. And that is incredibly attractive for investors. When you have great fundamentals and very low stock prices, typically that has to change. And that's usually changed with very much higher stock prices in the future. But you're right, the corporates will only start to come in when sentiment turns, stock prices start to move, and the overall sentiment for junior mining stocks improves. They'll all want that kind of herd mentality, like Peter said. Corporates and fund managers are all the same. We want to be able to say, yeah, I'm doing that too. I'm doing M&A, or I'm buying uranium, or I'm buying gold. It's a bit of that herd mentality that comes back to the market, but the fortunes are made when you go against the herd.
If you look at how commodities are outperforming the stocks, some skeptics might say this is a value trap. How would you respond?
I would say the macro debate that we talked about on gold is if one of your viewers or investors can show me the path how we get out of this financial debt issue we have in the country, that would be bearish for gold. But all the facts I laid out for your viewers today, they're pretty hard to dispute how we're not going to get out of this debt crisis without printing money and having much higher inflation structurally over the long term. And the last time we had that setup was in the 70s, and gold was by far the best performing sector during that period. So I'm all ears for how, the US is going to get out of the situation, how we get out of it with productivity and lower inflation. But if you believe the view that we have too much debt, we have to monetize it, that inflation is going to be higher for longer, gold should do extremely well. It's already doing well, and the stock should play catch up with that thesis over time.
Peter, how do you expect gold to do during a rising debt environment?
Well, I think the single bullish factor for gold is the continuing major accumulation by key central banks, particularly China. They don't do these things for trades. They don't do it because of speculation. They're doing it because they want to get away from one thing, which is the dollar. That's why they've been aggressive sellers of things priced in dollars, particularly bonds. And they recognize the changes in the world that are happening because of what's happening to BRICS. I think it's very important before we go to spend a couple of minutes on what this BRICS situation could mean, and I'd love to hear Michael's view, because that is going to require, to be successful, something different than the dollar. And that's what they're working on. And many of us are speculating it will be either a direct new currency or something that has partial backing of commodities, in particular gold. And that's one of the major reasons why those countries have been accumulating it so aggressively.
Okay. Michael, do you agree that a gold-backed currency could be in the works?
No, I think there's some simple numbers I'll leave you with, David. 67% of the reserve assets globally are US dollars today, 7% of gold. The facts are undeniable. Over the last 2 to 5 years, the Chinese, the Russians, the Indians have been selling their treasuries relentlessly. And now the money's showing up and they're buying gold. Why are they doing that, David? Well, US dollar is the reserve currency of the world. I'm not here to say it's going to change. Reserve currencies take decades to rotate out of. But what you're going to see over time is if you're selling US dollar, are you going to buy the Japanese yen? Highly unlikely. Are you going to buy the euro? Highly unlikely. Going to buy the won? Probably not at this point in time. So what do you do if you're selling your US dollars? You've got to buy money, real currency. The currency that's existed for 2,000 years is gold. And you're seeing that in relentless central bank purchasing. So US dollar, 67%, gold, 7% of FX reserves. I see over time that 7% going to 10, 12, 15%, US dollar going from 67 to 60. That would have massively robust implications for the gold price going forward. And you just have to ask yourself, what else are they going to buy? And I think that's the key where you're seeing the purchase of central banks is they're rotating out of the US dollar into gold. I'm not so concerned about when the BRICS start their own currency, what's going to replace it. What's replacing it now is gold. Gold's been money for thousands of years, will continue to be money for thousands of years. And that's the trend we're seeing, real money flows. In the physical commodity market, you're seeing that. It hasn't translated yet to the equity markets, but that's the next step. That's the most exciting part for investors, to be able to capture that in the equity markets as well.
Just to play devil's advocate, Michael. So some people have said, not everyone, but some people have said that were pointed out that during the Bretton Woods period, which is 1945 to 71, inflation in the U.S. was relatively stable. Some have pointed out to the fact that a gold standard stabilizes the monetary system, stabilizes the money supply, and hence stabilizes inflation. So wouldn't a return to some sort of gold backing be the solution to this mounting inflation and debt problem that you were describing earlier?
Absolutely. I mean, that is a solution, David. We haven't talked about that, but you look about why was inflation stable from 1945 to 1970? Was the currency was backed by gold. So the US government did not have the ability to go print $2 trillion of debt on a whim like they do today. So if we did that, David, the gold price would probably, I don't know the number, would go to $5,000-$10,000 an ounce. How much gold would you need, or what's the price of gold that you would need to back the currency today, considering the amount of money it's in circulation versus 1970? A significantly higher gold price. And that would put a permanent bid in gold. So you'd have if we did that, Dave, you'd have a massive re-rating in gold, maybe a double or triple from where it is today. And then yes, gold would be stable if you're able to use that to control government expenditures. But that process, Dave, would be incredibly painful. We talked about that. What do you cut? Where do you cut? You cut Social Security, you cut healthcare, you cut defense. Those are difficult decisions to make.
Hypothetically, I'm not saying this is going to happen, but hypothetically, if we do have a gold backing like you just described, yes, it would potentially fix inflation. But then what is the investment thesis for buying gold? Because then gold would be fixed, right? There's no upside or downside.
Well, then your gold would be backed by the amount of extra currency you need to print. So if you want to borrow more money or print more currency, you have to buy more gold. So gold would go up in line with inflation or the amount of money in circulation at that time. But there'd be a massive re-rating in gold. I don't know, from $2,000 to $5,000-$10,000 an ounce if that happened, because the price of gold would have to re-rate so much higher to underpin the financial base of the world economy. I don't think the government's going to go there, David, because it would show how worthless their paper is if they did that.
Okay. In the last segment of our conversation, we talked about macro gold. I'd like to ask you both, you're both seasoned investors, for lessons you've learned throughout your investment journey, and how these lessons could be applied to today's macro environment. Peter, I'll start with you. You were known as the whiz kid, or the whiz kid of Wall Street. You've been involved in this space for many, many, many years. You've been a veteran investor for many decades. Tell us some of the earlier lessons you've learned from your I guess from your earlier days, and how those lessons could be applied today.
Well, I've been on both sides. I've been a whiz and I've been a fizz. So I can tell you within 40 years, a lot of lessons in that. I think some of the things to take into account is slogans that I've come up with over the years. Maybe I'm not even the originator at this point in time. One is the ultimate crime in investing is never being wrong. It's staying wrong. And one of the biggest things that gets in our way, and it got in my way as a money manager, particularly, and Michael could share, I don't think it affects him. That's one of the main reasons why I think he's different than most. But when we get hubris and we get egotistical, that gets in our way of decision making. And we start making decisions from the worst possible investment strategy in the world today, David. Do you know what it is? Hope.
Please tell us.
Hope. It's a wonderful spiritual strategy, no matter what your religion may or may not be, but it's the worst strategy to depend on as your main factor, what may or may not happen with your investment.
What do you mean by hope? Hope for what?
Just hoping things get better. I hope this goes back up. I hope they don't run a deficit. Right. I can't tell you how many people actually invest on that basis. Okay. So that's another way.
What's the difference between hope and a forecast?
Well,
the forecast is backed by facts, hopefully.
I'll just tell you this. If you're going to depend on a crystal ball for making a living, I'll tell you what 40 years has taught me, David. Make sure you learn and can accept eating a lot of broken glass. Being wrong is part of the equation here. I'll get people that'll still talk about something I did 25 years ago and go in one of your comment sections and bring it up. You know, if you made 100 forecasts in 40 years, it's going to be something that didn't work out. So when you say something negative about somebody, give them also the credit they have. I just think that I think this is probably the most important thing. The way the market existed 40 years ago, and you and I like to joke about this off air, it is a dinosaur period then. It's almost 180 degrees different. When I started, 90% of the trading was individual investors. They were buying stocks to be part ownerships of businesses. Now over half the money is in non-actively managed accounts. They're tracing some type of index and indice and hope to profit from that. The remaining 50%, 80% of that is some sort of computer algorithm driven program, whether it's just simply buying and selling things on news stories or words in news, or very sophisticated using a bunch of futures, options, and other sorts of strategies. Very few people still go at markets as they did 30 or 40 years ago. And why I like to point that out, because a lot of my clients are of my ilk, my age. You can't keep looking at the markets the way you did 30 or 40 years ago. That type of analysis, whether it's technical or fundamental, is going to fail you because it's a radically different species. To me, it's a very high sophisticated casino, and the house normally wins in casinos.
All right. Thank you for that, Michael. Same question to you. And I'd like to extend that a little bit. Peter mentioned that nobody can be right 100% of the time. This is where risk management comes in. How do you, as a manager, manage risk?
I've learned, I'll take that in a different angle, David. I'll say I've learned over the years, 25 years investing, especially in the commodity sector, is being contrarian is the way that you can make a lot of money in the sector. It doesn't feel good, but when you're buying sectors or commodities, when you feel like throwing up, everyone hates it. You're getting hate mail in your inbox, hate messages in your text inbox. That's definitely, and when you have solid fundamental backing for your thesis, you talk about, David, between a hope and a forecast. A forecast is backed by fundamental analysis, facts. You can't always get them right. But if you put the facts on your side, your chances of being right are going to be much higher than if you're not. So I'd say in any sector, whether it be the tech sector in 2001, oil in the 90s, oil in 2020 when it hit zero, maximum pessimism, maximum hatred, maximum negativity. When you have a different view where you're positive and everyone else is negative, that's how you make spectacular returns in the market. But it's very, very difficult. You've got to be patient and you've got to be ready to lose money. Some of the best stocks in my career, David, that have gone up 10, 20, 30, even 50 times on my initial investment, have all had corrections where they've gone down 50 to 70% during that, 50 times your money type run. So you've got to have the stomach to kind of go against the crowd. You got to have the patience to let these stocks correct and do a lot of wild moves along the way and stick to your fundamental thesis. But by being contrarian, you're getting the odds on your side, but you've got to have the patience and the stomach to bear out that negativity that can last always a little bit longer than you think, maybe 6 months, a year, 2 years longer than you think. But eventually you'll be rewarded, and you're buying things so cheaply that the returns are spectacular from those points in time.
Excellent. Well, thank you both, gentlemen, for a very thorough discussion. Where can we learn more about your work and your research if it's public? Peter, I'll start with you.
Well, petergrandich.com is the website, but much of my time now is spent on Twitter. I can't call it X. I'll call it Twitter to the day I die. But it is, I think, for someone that used to take 4 to 5 days to get a newsletter out and in the hands of clientele, to be able to type on this keyboard now and everybody see it as soon as I'm done is one of the positives of technology changes, and one of the things that I like most about the current market versus 30 or 40 years ago.
Okay, good. And Michael?
Okay, I'm not on Twitter, but my views are pretty public. I'm pretty often, maybe once a month or so, on YouTube with my updated views, like on interviews like this. Thanks for having us on. So YouTube's a good way to reach me. Bastion Asset Management, unfortunately, is for accredited investors only in Canada. But if anyone's an accredited investor in Canada, they can try to contact us. But we don't do any marketing or solicitation online.
What's the YouTube channel we should follow you on, Michael?
I'm on my own channel. I rely on wonderful hosts like yourself, David. So if you just YouTube search me, I'm not trying to compete with you, David. I'm just a guest.
I understand. All right. Excellent. Well, thank you very much, both of you, for your time today. And if you're watching this right now, make sure to follow Peter and Michael in the links down below. Thank you again.
Thanks,
David.
And don't forget to like and subscribe. I'm David Lin.